Hello and welcome to another accounting video. In this video, we are going to look at balance sheet, also commonly known as statement of financial position. The main purpose or the idea of this video is to how to read or interpret a balance sheet. So basically, we are going to look at what balance sheet reports and how to analyze the numbers in the balance sheet or statement of financial position. So let's look at what balance sheet is in summary. If you want to watch a detailed video, I do have a video where I have discussed about all types of financial statements, because balance sheet is just one type of financial statement out of 4 financial statements that company usually report. So you can always watch that video about financial statements on my channel. It's there. Please feel free to watch that. So let's look at what balance sheet is. As I said, balance sheet is also commonly known as statement of financial position. There are 2 most common methods that a balance sheet can be prepared in, T account format or a report format. This is the most used format, I would say, most used format, the report format. And T account format, it would be like a T account. If you know what T accounts are, it's like a T account. On this side, on one side, you would have assets, and then on the other side, you would have liabilities plus equity, which brings me to my point that balance sheet is actually also a representation of accounting equation, that is asset equals to liabilities plus equity. So companies will be reporting their assets, their liabilities, and equities on a balance sheet. Another feature that you would see in companies' annual report would be that they would be reporting comparative balance sheet. In other words, in very simple words, it would be reporting balance sheet for 2 years or maybe more. So you have a comparable data. You would have data for 2 years, and then you can run some numbers, you can calculate some ratios, and then see what's happening in the company. So let's look at an example. This is a financial statement, more specifically a balance sheet from Starbucks, right? So as you see, this is in millions dollars, in millions, right? And this is, the currency is USD. The currency is actually USD. So let's look at another thing is that this is a report format. This is a report format instead of T format, right? So you see assets are reported and then liabilities and equity section. So 2 sections, 2 main sections, assets and liabilities. Plus assets, there are 2 types of assets, current assets and non-current assets. So if you see here, you have all these current assets here, and then you have all these non-current assets, and then you just sum them up, the company will sum them up, and then you have total assets. Then for liabilities, as I said, again, you would have 2 types of liabilities, non-current liabilities and current liabilities. So if you see here, this section until here, it's all current liabilities. This is a total of current liabilities. And then here you have all these non-current liabilities. So you sum these 2 sections together, you add them, and then you have something called total liabilities. You have total liabilities here, and then from here you start with equity section. The company starts with equity section. In equity section, you would have all these common stock, additional paid-in capital, retained deficit. This means that company has a loss. Company has a loss. If it was positive, then it would be called retained. It would be called retained earnings. Right. So you have these all these numbers here. If you see, since as we said, it's asset equals to liabilities plus equity. So total assets here must be equal to liabilities plus equity section for both the years. Let's look at which years are these. So this is 2019 and this is 2020. So if you see assets equal to liabilities plus equity, this is a key feature. Balance sheet must balance, and it will report assets, liabilities, and equity. Right. So let's look at some common ratios that you can, as an investor, you can calculate from balance sheet. 2 most common ratios are quick ratio and current ratio. They basically tell you about the company's ability to pay its short-term obligations. right? A third ratio, it could be debt to equity ratio. This is a leverage ratio. This is a leverage ratio. It tells you how much debt company has in terms of equity. So you can actually go back, find these numbers from the balance sheet and calculate these ratios, or you can easily find the statement or these ratios in company's annual report as well. So Starbucks is a listed company. The annual report is a public information. So you can always look at these ratios in the annual report, because Starbucks might have, or any other company that you're interested in, might have calculated these ratios in the annual report. The other two ratios could be accounts receivable turnover and accounts payable turnover. And there could be several other ratios. There could be several other ratios besides above. So these two ratios, more specifically, they are related to operating activity or operating performance. And the formulas are here for you. These are the formulas. These are all the formulas. So you can always look at a company's balance sheet and then calculate these ratios. Thank you very much for watching this video. If you think it was helpful in understanding balance sheet, please give it a thumbs up and subscribe to my channel for more videos like these. Thank you very much.